Bismillah ar-Rahman ar-Rahim. Today we will start our online teaching by focus on financial statements. We said before that the accounting system consists of three contents: input, processing, and outputs. We talked about input, which was the business transactions, and processing like recording, summarizing, and outputs are the financial statements. And we said before that we will focus only on the financial statements as a major component of the accounting system. Today we'll start to study the financial statements. It is according to standards. You prepare your financial statements as a company according to the standards. The standards say that you have to prepare 5 financial statements to report your financial information about your business to the external users like owners, creditors, government, tax authority. You have to prepare your financial statement at the end of each accounting period. Could be months, quarter, year, according to the type of the accounting system you have or the type of the business you are working in. These financial statements is 5. First is income statement. Second, comprehensive income statement. Third, the owner's equity statement, balance sheet, and the last one is a statement of cash flow. And we have notes. Notes is some disclosure about some items in this financial statement need more disclosure about it. But we will focus on income statement, owner's equity statement, balance sheet, because the other 2 statements more advanced for our course. So we will focus only on income statement, owner's equity statement, and balance sheet. Okay, let's start. The income statement take this shape. We have 3 lines above the statement. We have to write the name of the company, the name of the statement here, income statement, and the date of the statement here for the ended, for the year ended, for the month ended, for the quarter ended. It is the date of the income statement. And we have content of the income statement, and we have revenues of the company during this period and the expenses during the same period, and revenue minus expense, yes, calculate the net income or determine the net income. If the revenue greater than expenses, so you have net income. If the revenue less than the expenses, so you have net loss. The income statement present a summary of the business entity, revenue and expenses. So the income statement consists of revenue and expenses only for a period of time. So it is a total revenue for a period of time and the total expenses for the period of time. If you pay rent expense $100 per month, so if you are preparing income statement for quarter, your rent will be for 3 months will be 300. So for the period of time means total revenue for this period of time and total expenses for this period of time. The income statement is like a video, a moving picture of operation. Let you see how the operation was acting during this period. The income statement as example, like this company, Campus Apartment Locators, it is the name of the company. The statement, income statement, the period for the month, it is for 1 month only, ended July 31st 2013. So we here have revenue and expenses for the month of July 2013. We have revenue and expenses. Revenue, service revenue 1900, and you have 2 types of expenses: rent expense, utilities expense, with a total 500. So this company during the month of July has revenue 19 100 and have expenses 500, so this company has a net income 1400. This net income will move to the second statement. We'll take this net income to the second statement, which is the statement of owner's equity. So you have to prepare the income statement first to prepare the owner's equity statement, because from the income statement you will get the net income. Output of the income statement will be input to the statement of owner's equity. The statement of owner's equity show the change in capital or owner's equity during a time period, or period of time. We have three things to affect the capital. Maybe the owner increase its investment in the company, so the owner investment increase its capital, and the net income outputs from the income statements resulting from the income statement will get as input in the statement of owner's equity. It will increase capital too if it was net income, but if the company has a net loss, it will decrease the capital. And you have drawings decrease the capital, so the owner's equity affected by three items: owner's investment increase capital, net income positive net income increase capital, loss negative net income decrease capital, and drawings decrease capital. And the statement will take the following shape. This is the campus apartment locator statement of owner's equity for the month ended July. Did you realize the three lines before the statement? And we have here 1400 come from the previous statement, income statement. So we have the Smith capital at July 1st at the beginning of the month. Assume it was zero. This is the first month of the company. We have owner investment increase its capital by 35. He has net income for the month 14, so we can calculate the total capital here 36,400. But he made drawings 1900, so the Smith capital at the end of the month will be 35,200. This 35,200 will go to the third statement, which is, yes, it will be the balance sheet. So you have to make income statement first to determine the net income. Net income outputs from the income statement and get input to the owner's equity statement. At the owner's equity statement, you will determine the capital at the end of the period. You will take this capital at the end of the period as input to the balance sheet or as item at the balance sheet. What about the balance sheet? The balance sheet, it is listed the assets, liabilities, and owner's equity. Asset, liabilities, and owner's equity, we talked about these three before. Yes, when we are talking about, yes, the accounting equation, basic accounting equation, when we said assets equal liabilities plus owner's equity. The balance sheet deal with assets, liabilities, and owner's equity, deal with the basic accounting equation, but at specific date, usually end of the month, quarter, year, as we said before. The balance sheet is like a snapshot of the entity. It is like a photo of the entity at exact time. Before this time or after this time, the balance sheet will change. Yes, you have in your treasury cash 10,000 at December 31st at 9 o'clock. Before 9 o'clock it was not 10,000. After 9 o'clock it will not be 10,000. So it is correct only at exact date. It is a snapshot. When I take a snapshot for a group of people, everyone has a situation different about each other. So after 1 minute the situations will change. So the balance sheet, it is a snapshot or a photo of the entity at exact date. It is also called a statement of financial position according to IFRS, International Financial Reporting Standards. the new standard or in the international standards, they call it statement of financial statement. But the common name is the balance sheet. The balance sheet mirrors the accounting equation as we said before. It takes the shape like you see at the campus department locator, name of the company, it is balance sheet. Did you raise this at, not for? So, income statement for the date. Owner's equity statement for the date. But balance sheet at exact date, at July 31st. So, if we have here assets and liabilities and owner's equity, we have assets equal liabilities plus owner's equity. Here assets cash 5,100. It is right or correct number exactly at July 31st. At July 30 it was not 5,100. In August 1st it will not be 5,100. So we just collect the assets and calculate the total assets. We have here liabilities and owner's equity. Realize that the Smith's capital 35,200 came from the previous statement, owner's equity statement. Did you realize that the total assets 35,300 equal total liabilities and owner's equity? We said this balance sheet is balanced. Balance means total assets equal total liabilities and owner's equity. So the basic accounting equation is balance. Okay, let's try example. We have here example. We don't read the example from its start. We read first the required. Prepare the following financial statement for Studio Photography Incorporation for the year ended December 31st, 2012. We need you to prepare three financial statements: income statement, statement of owner's equity, and balance sheet. Let's see. Income statement contain of revenue and expenses. Statement of owner's equity, you need capital at the beginning, owner investment, and net income. Before you do it, you have to prepare income statement to determine it, and drawings. Balance sheet, yes, assets, liabilities, and owner's equity. Let's see. Studio Photography works wedding and prom type parts. The balance of Ansel is the owner of the business. Ansel capital was 16,000 at December 31st, 2011. Realize that he need financial statement at the end of December 31st, 2012. But he gave me the capital at December 31st, 2011. Yes, it is the end of 2011, so it is the beginning of the 2012. Yes, the ending of December 31st, 2011, it is the same number as January 1st, 2012. At December 31st, 2012, the business accounting record show these balances. Let's classify it together. Insurance expense, it is expense. Cash, asset. Accounts payable, any payable must be liability. Advertising expense, it is expense. Service revenue, it is revenue. Ansel drawing. Accounts receivable, yes, it is asset. Note payable, liability. Ansel capital, it is owner's equity, capital. Salaries expense. Equipment, asset. Owner investment, it is investment by owner, part of owner's equity. Did you realize that the Ansel capital at December 31st, 2012 is missing? Yeah, you have to calculate it from the statement of owner's equity. Okay, let's start. First, let's make the income statement. Studio Photography, name of the company, income statement for the year ended. We prepare here the income statement for year ended December 31st, 2012. All we need is revenues and expenses only. Here we have revenue 80,000 and you have 1, 2, 3 types of expenses: insurance expense, advertising expense, salary expense, with total 36. So this company has a net income because revenue 80 greater than the total expense 36, so we have 44,000 net income. This 44,000 will go to the, yes, to the second. which is statement of owner's equity. Name of the company, Studio Photography. Name of the statement, statement of owner's equity for the year ended December 31st, 2012. What this statement include? Let's see. Yes, Ansel Capital, December 31st, 2011, it is the beginning of 2012. End of 2011, it is the beginning of 2012. He has 16,000 from the last year as a capital. This year, he made additional investment to the company, 29, and we got 44,000 from previous statement as income, and he has drawing 13,000. So Ansel Capital December 31st, 2012 will be 76,000. This number will go to the to the balance sheet, the third statement. Okay, Studio Photography, name of the company, balance sheet, name of the statement at December 31st, 2012, and we have only assets, liabilities, and owner's equity. Assets, cash, accounts receivable, equipment was total 95,000. So the total liabilities and owner's equity must be 95,000. We have accounts payable 7, we have notes payable 12, with total liabilities 19. Where we can get the owner's equity from the previous statement? Yes, it will be 76 Ansel Capital at the end of the 2012. The equation is balanced, total assets equal total liabilities plus owner's equity. And you have this assignment. Please try to solve it, and I will check it with you next time. Thank you. Please get safe and take care of your family too. Thank you. Bye.